So I will try to explain what type of convergence might be of interest for the EMU and how we could be trying to reach it. When I was asked to do this paper, so it took this form, published in June, last June, when I was asked about this policy brief or report, it was in January 2018. And when I saw the topic, I wondered what were the papers that had been done on this particular topic just before me, maybe recently. I was very amazed that the European Parliament would ask, in fact, two groups of people, Germans, myself, to deliver something on convergence in the EMU, because two institutions had delivered full comprehensive papers on this issue, namely the European Central Bank and the IMF. European Central Bank, my guess, it was in December 2017, and the IMF 2019, okay, January. So I was a bit puzzled because I was wondering what I could be adding to the issue when teams of the ECB, teams of the IMF had already worked on the issue. But in fact, it gave me some blank document to be writing, because I was given the opportunity of deciding upon convergence in the EMU. I consider that what I should be doing, as humbly as possible, was what should we be doing, what could be the recommendations as far as convergence would be needed. Okay, so that was the thing I had in mind, but I felt I was a bit alone, a small guy, French, not a German, dealing with convergence in the EMU. So I was wondering how to do something that might be, to some extent, new. So what I did was first to think about convergence. Why do we speak about convergence in a monetary union? Who has been working on the issue theoretically in the past? And what has it delivered? So the first thing had to deal with was, should we need some convergence sharing the same currency? And if we need some convergence, what type of it? Would it be some nominal convergence? Would it be some real convergence? If it's nominal, what type of nominal convergence? If it's real, what type of real convergence should it be? Okay, so I felt alone, but decided to do it on my own. At this moment, I was not teaching at the SCP Europe, and I was very often at the OFCE, although I said, okay, maybe that's time to think alone and do something. I do not mean that I made a revolution, very far from that. Also because I had to write this report, put it at the European Parliament, have their feedbacks, these people telling me what you say might be wrong, what you say might be right, but it's infeasible. So if it's infeasible, it's not something that you should be telling. So consider that if it's not feasible according to someone at the European Parliament, doesn't mean that it's not feasible at all. So I consider that I should be talking and having some feedbacks with them. So I wondered about the convergence, and I tried to contribute to the debate in two different manners. The point I will try to raise with you is that if we deal with convergence within a monetary union, there are at least three types of convergence that must be dealt with. Okay. The first one is the usual convergence of trying to reach a higher level of well-being, GDP per inhabitant, whatever you want to put in it, which is a domestic goal. Okay? So the idea is it important for the euro area as a whole, or the monetary union as a whole, to have common tools in order to improve the convergence of a given country towards a higher steady state? Let's call it like this, a steady state. A better standard of living, better GDP per inhabitant. The second question is, as it stands today, the euro area has objectives in terms of financial convergence. Okay. Maybe you heard about public debt to GDP ratios. to which all countries should be converging, usually as rapidly as possible in the past, not usually, but initially as fast as possible, now over a 20-year horizon. Okay. So that's related to some kind of convergence towards an indicator of so-called fiscal sustainability. So I consider that we, or I, should be recommending some changes in this respect. And then there was this issue that was created by Mandel in the 60s that considered that we needed, in a monetary union, to have it be optimal, some cyclical convergence, okay? Which is something totally different from the other converging and convergence indicator. So this is my certainly very minor contribution to the debate. And the second minor contribution to the debate are 11 recommendations. Okay. So I will tell you about 10 out of these 11 recommendations, and maybe your friends will be willing to discuss about it. Okay. So, as you could see, I started with a quote by President Macron, so far as he's still the French president. So at the moment he had these words, he was the president of France, April 2018, and he said that the meaning of the European process is the improvement in convergence. Okay. When I said that at the European Parliament, they stopped quarreling with me about my paper. Okay, I said, okay, if the President Macron is behind that guy, they stop. If I had done this week, maybe they would continue quarreling with me. But at the moment, I was finishing the paper, European speaking, Macron was still credible on the European scene. Okay, so my outline for the remaining 40 minutes is describing briefly one indicator of real convergence that has been used in the literature and has been used by the ECB. Then discussing about why we should be interested in convergence if we share a single currency. Then I will deal with the proposals that have been put so far in the debate by the Commission last December, by the group of so-called 14 Franco-German economists, so-called because there is a lady, she's from Swiss. So there's not only German and French economists. So they had some ideas, and I will show you that the Commission is willing to improve cyclical convergence and does not care that much about the rest of indicators of convergence, whereas the 14 Franco-German economists are dealing almost exclusively with financial convergence, okay? Fiscal sustainability and private sustainability, private banks' solvency. Okay? This is their main point. They do not deal with other types of convergence. Then I will briefly discuss the achievements of this week, because there was an agreement by the euro area finance ministers on a reform of the euro area, and then I will speak about myself. Figure 1, beta convergence. The ECB, the IMF, anyone is usually willing to figure out if ever countries with the lowest income have been able to grow faster than the countries with the highest initial income. Okay. So beta convergence just means that the worst students improve faster their marks. Okay, that's beta convergence. You start from low. If you start from low and there is some convergence towards those that start very high, you should be having higher growth starting from low than those being on top. Okay. So this graph shows since 1999, top left, until 2016, I guess. Sorry, 2016, yes. The relationship for each country between its initial level of income per inhabitant above or below the European Union mean, and on the y-axis, its growth rate over the period. So on the x-axis, you have the level of income per inhabitant in 1999, and on the y-axis, you have the growth rate from 1999 to 2016. And the striking thing here, there are two striking things. The first one is that it seems that there has been some convergence from the lowest income per inhabitant country towards the highest income per inhabitant countries. Okay? Romania has had a sharp increase in its GDP per inhabitant growth, whereas the Netherlands has had a low growth rate of its GDP per inhabitant. Okay? So it seems that the negative line works well to show some beta convergence. Okay. That's the first point. So it seems that since the euro was created, there has been some convergence of the lowest income countries towards the highest income countries. But if you look only at the blue points are the initial member states of the euro area. If we only had these countries and we were witnessing beta convergence for these blue countries, the initial member states of the euro area, there would not be any beta convergence at all. And if ever there were a relationship, it might be positive. Starting with the lowest income, you will be finishing with the lowest growth rate. Okay. So you have countries in great despair, like Greece, like Portugal, like Italy, that point to this absence of beta convergence. So the point that has been raised in the literature is that, yes, the EU is gradually performing better, and the lowest income countries are gradually converging. But if we just look at the euro area member states, they don't. Hence, there is a problem with the euro area itself, which can be related to many things that I will be dealing with in a minute. Okay. Okay, so we have an issue with convergence. Why do we care? Maybe we should not. Okay. My point of view is that we should care for at least three reasons. The first one is that real convergence is in the treaty. Real convergence within the European Union is part of the objectives since 1957 of the European Union. And these objectives have not changed since then. Okay? So we are having a consolidated treaty that has taken fully the objectives of the Treaty of Rome 1957. So we know the basic objectives of the EU: promoting peace, promoting the values of the European Union, and the well-being of its people. Okay? But there are some other complementary objectives, like boosting competition. Okay. This is part of the treaty. We might be thinking that it is not useful to always foster competition, but it is in the objectives of the treaty. If you don't do that, the German lawyers will tell you this is not the treaty as it looks like for 60 years. Okay? That doesn't mean that it should be perfect competition, because we may be considering that we live in an imperfect world where imperfect competition is possible, but every policy by the Commission as regards competition will be to find out a way to limit distortions and to improve competition. That's our first objective. But the second objective is wider. Sustainable development based on balanced economic growth and price stability was written down in the Treaty of Rome. It's not the ECB's motto. No, The ECB was not there at this moment. It's the Europeans that decided to have sustainable development, economic growth that will be balanced, price stability, a highly competitive, but social market economy, aiming at full employment and social progress, and a high level of protection and improvement of the quality of the environment. The environment, the sustainable development we're talking about, is the same today as it was 60 years ago. Of course, the EU does not certainly deliver on these objectives perfectly. But the EU is not responsible at top level on all these objectives. There is a subsidiarity principle that leads governments to decide upon the policies on which they will be more efficient at moving things in the good direction. Okay? So that means that, socially speaking, there is almost nothing in terms of the European social policy, although they have been pushed towards it. But usually governments say this is a national prerogative. Okay? We do what we want as regards our social protection, provided it improves, although we know it does not. But that's another issue. Okay? Third objective, the promotion of economic, social, and territorial cohesion and solidarity among the member states, which means that with the second point, it seems that we should be having some convergence of individual member states towards the highest possible steady state. Okay, I remain very abstract. What is the steady state? Large question. But we should also having tools in order to have some countries converge to, let's call it Germany. Okay? That's part of the deal. That's part of the deal for 60 years. Which leads me to a first definition of real convergence, which is we should be moving towards the highest living standards. Okay? Taking the different objectives, we should be closing income discrepancies, we should be achieving cohesion with balanced growth, price stability, full employment, whatever. Okay? But we need tools for that. Okay? Most of the tools to achieve that are national tools. The argument I will be having is that countries that cannot deliver on these tools are lagging behind with possible spillovers and negative spillovers to the others. Okay? If we want to move forward and the group is not homogeneous, certainly it's not good even for the leaders. Okay? So that might be meaning that the leaders might be willing to use some common tools to help an individual country to move forward. Okay? Having no laggards is in the interest of the leaders. I must admit that my journey in the EU is the journey of a naive. Okay? I took the position of being very naive. Okay? I will propose recommendations that you have heard about, that you could have delivered the same way as I did, but that most economists dealing with this issue do not tell because they're told it's impossible. Okay? So I decided to write it down. So I'm just a representative of so many others that will be thinking the same, and I have, as your colleagues have been able to see, or maybe you read the paper, I have some references. Okay? There's almost nothing from me, except that it's in a single package. Okay? I put everything I wanted in this package. I had 25 pages. I put everything. Okay, so I'm a naive. Okay, I know that the leaders sometimes do not want to help the laggards, but my point of view is that it is in their disinterest of doing so. Okay, so I have this first definition. Maybe I went too quickly because I thought I had 45 minutes and not 1 hour. I have decided to scrap very, very rapidly the question of nominal convergence. These objectives are real. We are talking about price stability, nominal. We're talking about full employment, real objective. We're talking about GDP per inhabitant. Okay? We're talking about social and territorial cohesion. This is not a nominal indicator behind. This is our real life. It's a real indicator. But you certainly know that to be participating in the euro area, you must fulfill nominal convergence criteria. price convergence, nominal long-term interest rates convergence, exchange rate convergence, public deficit below 3% of GDP, and public debt below 60% of GDP. Okay. When they were decided upon, the philosophy behind was if we achieve nominal convergence, real convergence will be pursued. Okay? Okay, so, but we know it did not happen. Okay? If we have had a crisis in Greece, it is not because the Greek government has not fulfilled the public finance agenda of the Maastricht Treaty or the Stability and Growth Pact. It's mainly because we have had divergence in terms of the real cost of labor between Greece on the one hand and Germany on the other hand. Okay? So maybe it's full fault of the Greeks, maybe it's half fault of the Greeks and half fault of the Germans. But these are real indicators that tell us what has happened and what was to happen. But at the moment it happened, we had almost no indicators stated in real terms to be able to witness possible divergences or convergences beyond, in the European Union and in the euro area. Just to remind you of something, before the global financial crisis, do you know what country was considered the best pupil in the classroom of euro area member states? Spain. Why?
I think they had the lowest budget deficit. They generally had like a really good convergence process to the parameters that were used at that time.
Yeah, thank you. So I need to say it again because I have the microphone. Sometimes I move the microphone, so my colleague here is a bit puzzled. Yes, you're right. So Spain was the best pupil in the classroom, for it was able, the government was able, not only to have the lowest public deficit, but to have a surplus. Wow. So in Brussels, they were saying it's possible. Look, they can have a surplus in their public finances. They can reduce their public debt to GDP ratio. These are good pupils. Okay. No one was looking on the side of the private sector, where the private debt was just soaring to levels that have put this economy in great despair. Okay. But this was not the fashion at the moment. Okay, so I decided to scrap very rapidly nominal convergence and to deal with real convergence. Why? Because that's part of the treaty. No one can tell me the contrary. Even someone at the European Parliament that doesn't like me. Okay. They don't like me, I'm French, whatever, I don't know. This is in the treaty. Real convergence is part of the treaty. So I can have my German style as well. I'm partly German-Swiss by my grandfather. Okay, so, but does not have the nationality. Okay, one other reason why I think it's important, and I'm not the only one, of course, that to think that real convergence is important for a euro area is to go to the founding father of the euro area, namely Robert Mandel. Okay? Robert Mandel dealt with the issue of asking whether two towns should be sharing the same currency. Okay? So if two towns are sharing the same currency, maybe two regions might be willing to do so, maybe two countries, and maybe we just need one currency in the world. Okay? But his story was, why do towns share the same currency? And he said something very easily understandable, which is because they have more benefits than they have costs. If Montreuil and Paris share the same currency, it's because it's in their interest. Otherwise, they would have their own currency. Okay. So he dealt with this optimal currency area stuff that tells us that at the size of countries, there are benefits with sharing the same currency among a large group of countries, and there are costs. What are the benefits? You know pretty well about the optimal currency area literature. I can skip, go quick. No, I continue. Yes, some no, some say no. Okay, the benefits. If you share the same currency as your partner for trade, you no longer have an exchange rate risk by definition. Hence, the cost of your transaction declines immediately. You have more transparency in the price of goods, the cost of labor, the cost of capital, if it's stated in the same currency. I can know that a car is cheaper in Germany than in France because they have the same denomination. They are stated in euros. Okay, so maybe that will have a competitive effect. The country in which the car is the more expensive will decide to reduce the price in order to remain competitive. When you got the same currency, you increase the size of the market, hence you have positive scale effects, macroeconomic effects, but they can for sure exist. You increase the size of the financial markets with more liquidity, hence interest rates are lower, the cost of capital is being lower, and you are more attractive to international credit from the rest of the world. Hence, you can finance more investment thanks to this attractiveness. As for the costs, there are three. The first one is you lose monetary sovereignty. The ECB is in charge of creating the euro, not the Bundesbank, not the Bank of Spain, nor the Banque de France. It's a pool of these central bankers that are sovereigns to some extent on this currency, but governments are no longer sovereigns. Okay? Which means that debts, public debts, can no longer be monetized. Okay? For a very long time period, a country, a government that had issues with its public debt could issue money to compensate for its problem. With sharing, having a default risk, it was creating money, paying back its debts, and they were no longer debts. But some were arguing that once you monetize your debt, you're creating inflation, hyperinflation, World War II, then a disaster. So you must not finance debt out of money. You also lose monetary policy as a domestic tool to deal with some adverse shocks in your own economy. And you also lose the exchange rate in order to compensate for these adverse shocks. Once you have a single currency, you cannot devaluate, and you know what happened to Greece. They could no longer devaluate. So the devaluation they have had to resort to was to decline prices and wages. Okay? Hence, turning into a deflation, and deflation calls for deflation and calls for a recession. Okay, so there might be costs to sharing the same currency. And the point that Mundell makes is that in order for the benefits to exceed the costs, there might be some conditions. Okay? I will not go into the different conditions that he talked about. I just mentioned one, cyclical convergence. If ever countries sharing a single currency are hit at the same moment and with the same amplitude by the same shock, there's no issue. A symmetric shock can be dealt with by a single monetary policy. Okay? If everybody turns into a recession at the same moment, the ECB should be decreasing its interest rate to foster investment, to foster consumption. And if there's a boom all over the euro area, we would be expecting a rise in the interest rate by the ECB. But there's an issue if some countries at some moment are hit by the shock. In this situation, two possibilities emerge. The first one is, in fact, it does not emerge because the countries have been able to converge to the same structures of their economy. the same GDP per inhabitant, the same social system, whatever. Okay? So they're the same. They achieve the first definition of real convergence. They reach the same steady state. Or they need some budget transfers, okay? Which is a novel story that can exist. So to smooth the functioning of an EMU, the European Monetary Union, you need convergence towards the similar structure and cyclical convergence. But we should not be forgetting that these cyclical convergence might be key to have a resilience of the euro area. If a shock hits Germany, the ECB cannot dampen the entire shock, okay? Because it's only Germany. Germany is a large country, but it's only Germany. It's just 1 out of 19 member states, 25% of the euro area. So Germany needs either to be in a situation of being hit by the same shock at the same moment as Greece and France and so on and so forth, or receive some fiscal transfers. In this respect, there will be some convergence. And finally, the treaty introduced these financial convergence objectives I already mentioned. They are debt targets in the euro area, in the European Union as large, and we also have seen the ECB have a change in its mandate, which is not a fully official change in its mandate. The ECB is also in charge now of financial stability and part of the banking union, by which it should be supervising the largest banks in the euro area and possibly beyond, which means that we should not be thinking only in terms of real convergence and cyclical convergence, but also in terms of financial convergence. Okay. Okay. So, what are the reforms? The European Commission, it seems, has liked the proposals by Emmanuel Macron at La Sorbonne in September 2017. In September 2017, Emmanuel Macron made a European speech in which he considered that we should be taking back our European sovereignty. And in order to get back this sovereignty, we should be resilient to different shocks. Hence, we need a Minister of Economics and Finance for the euro area. We certainly need a European Monetary Fund. And we also need a stabilization function at the level of the euro area. Sorry, it's a stabilization function at the euro area level, some cyclical convergence being dealt with by Macron in September 2017, then by the Commission in December 2017. So what does this stabilization function looks like? Okay, so take some time to discuss about the proposals of the others, the achievements of this week, then I turn to my very humble and ridiculous recommendations, of course. The first thing here is to make sure that in case of a shock, that would be an asymmetric shock, there would be a budget dedicated to dampening this shock that could be activated very rapidly. And that would be complementary to national budgets. Okay? At the moment, we have a European Union budget for the entire European Union, which must deal with cohesion policy, convergence of the low-income regions, low-income country towards the high-income region, high-income country. Country. You have the common agricultural policy, and you have a competitive objective. Okay, so that's the EU budget. But there's no budget dedicated to smoothing the business cycle. Hence the proposal. Making sure that if Greece is still in the euro area and is hit by a shock, there's some funds somewhere to help this economy recover as fast as possible in complement with its own policies. Okay, so the idea is very nice. It's very in the spirit of Mandela. Okay? There should be transfers. But the problem with transfers is that you may be sharing risk. The country that has not been hit by a crisis will have to help through the funds the country that has been hit. But maybe the country that has been hit is a bad country, having had bad economic fundamentals for years, not sound public finances, and there is a risk sharing. And some countries do not want any risk sharing. Sound public finances, it's the type of things that you read in the Commission, the ECB reports, in many things. Okay? I don't know what it means, sound public finance, because there's no definition. It means that you certainly comply with the fiscal rules. Okay, so initially it's very generous, but comes the eligibility criteria. If you are being hit by the shock, the asymmetric shock, you will be helped insofar as you fulfill these eligibility criteria. The first one is that the asymmetric shock is large. Okay? So it's not for a small shock, it's for a large shock. Keeping in mind, therefore, that small shocks should be handled by the country itself. Okay? So large shocks, I will come back in a minute to this, to the definition. The second thing is that it should be neutral over the medium term, meaning that there should not be, in the medium run, a deficit of this budget. The EU budget is never in deficit. It's forbidden. You have as many resources as you have expenditures. With these budget dedicated to dampening the business, smoothing the business cycle, you may have a deficit, but only in the short run, which means that if we have to help the Greeks for a while, they will have to pay back very rapidly, within 2 years, let's say, midterm. Okay, so that's a bit weird if we think in terms of the fiscal multiplier effect, the story behind Keynes and Havelmo, showing that the highest fiscal multiplier is being obtained after a deficit has been created, not under balanced budget. Having neutrality means balanced budget in the medium term. That means that the fiscal policy that would be implemented would not be the most effective one. And then, the best part of it, if you are being hit by an asymmetric shock that is large and you want to be helped, no problem, but you must have, before that, complied with the EU surveillance framework. Which means that, for instance, if we had this budget at the moment Greece turned into a crisis with a recession, since Greece was not able to comply with EU fiscal surveillance, we should have been doing nothing to help the Greeks, which means nothing new. In contrast with what we did with them, we should have been asking for austerity. Okay? There should be, since neutrality is only achieved in the medium term, there is some borrowing capacity of this budget, can issue some bonds, but in the mid-run, this budget must remain in balance. These are the words of the proposals. There are two things that are to some extent interesting, at least to me, maybe not to you, but to me, maybe I lost you already, which is that the large asymmetric shock is given some kind of a beginning of a definition. Okay, some kind of a beginning of a definition. What should be a large shock? It would be still a large temporary deviation from the trend in unemployment or the trend in investment. So if the unemployment rate rises rapidly, unexpectedly, this could be considered as a large asymmetric shock, and the country being hit by this unexpected increase in the unemployment rate might be helped through the budget, provided the other eligibility criteria are being fulfilled. And finally, the Commission has been very happy with the Juncker plan. The Juncker plan is this plan that was decided upon in 2015, maybe, to boost public investment and private investment in the European Union. Okay. So they're so happy with that that they consider that they should be using a budget for the euro area via a support on public investment. Okay, so if ever this budget existed and a country were being hit by this negative shock, it would find funds to increase rapidly public investment. Okay. So public investment is usually the tool that gives the highest fiscal multiplier. Okay. You look at the literature on the fiscal multiplier, and you can see that this is usually the best tool to increase growth rapidly. Okay. But maybe not that rapidly. I will come back to this issue. So that this is the first reform that has been discussed. 15 minutes, yes. But starting with 45 minutes or 1 hour?
1 hour.
Yes, 1 hour. Okay. Bad news to me. So I will continue with the Germans and the French that have focused mainly, I will go more rapidly on them than on the Commission, that have focused on the vicious circle between banks and governments. They saw in the statistics, as everybody can be seeing, that most domestic public debts are being held by domestic banks, which means that a risk of default on the government means a higher risk of default on domestic banks, or a default possible on banks might mean that no one will be willing in the future to buy new issuances of public debt. Okay, so there's a vicious circle between domestic governments in the euro area and their banks, private banks. So what they propose here is to cut this vicious circle and to introduce a limit on the concentration within domestic banks of domestic public debt instruments. Okay. So that means that Société Générale and BNP Paribas and other banks in France will be able to buy some bonds, public bonds from France, but up to a certain level and below the level at which they are usually and currently buying these bonds. Okay? So this will be a limitation in the ability of private banks to buy whatever they want in the euro area. Okay. And they also make a plea for a common deposit insurance in order to limit the risk of bank runs on our banks. Okay. So they want to have private banks be more solvent than they are today, according to them. And then they propose a change in the fiscal rules. We have many fiscal rules in the euro area, so we must limit the public deficit, we must limit debt below 60%, we must converge towards the 60% by 1/20th per year during 20 years in order to achieve the target. So we have a target on the structural deficit, cyclically adjusted deficit, and we must make improvements of 0.5% of GDP per year if the deficit is above 3%. Okay, 5 fiscal rules. They propose just one. Good idea. But this has an advantage and a drawback. The advantage is that it would make it possible, if it were implemented, to have automatic stabilizers play fully. Why? Because they will introduce an expenditure rule for expenditures that are not related to the cycle, meaning that all expenditures related to unemployment benefits would be scrapped from the rule. Countries with high unemployment benefits could have high unemployment benefits, but the remaining expenditures should follow a rule. Okay? So that means automatic stabilizers would play better. But the drawback is that they want banks to remain solvent and they want to achieve so-called fiscal sustainability. And structural expenditures must decline if debt ratios are above the debt limit. which means that, okay, that's good. You might be having higher spending in the short run, potentially higher spending in the long run if you want to boost via the public sector potential output. Why not? But you won't be able to do so if you are an Italian government, because your public debt is largely above 60% of GDP. So that's a good rule for the countries below 60%, not too tough rule if you are close to 60% but above, but a very strange rule in terms of the flexibility that it does not give if you have a large public debt to GDP ratio. So my point here is that they deal more with financial convergence than with anything else. Okay, I scrap this. Recent achievements. Considering that we lack some cyclical convergence, real convergence, and financial convergence within the euro area, what has been decided upon last Tuesday in the morning. The first thing has been to reaffirm the last resort character of the European Stability Mechanism, by which it is possible to use the funds available to help banks and governments that are facing a default risk. But this will be related to the fulfillment of some criteria. And among these criteria is the following. You may be having access to more funds if your country has been hit by an adverse shock, provided that before the shock you had sound economic fundamentals, meaning you were complying with the fiscal rules, meaning you had full employment before the crisis. There's a shock, you're being helped. But countries with high unemployment will not benefit the system. Okay? So the system is an improvement to the countries that do not need to be helped. Because if you have had sound economic fundamentals and you're being hit by a shock, you can use your national fiscal policy. Okay? You can change the income policy. Okay? You do not need the ESM. The countries that need the ESM are those with very large unemployment rates, very far from sound economic fundamentals. So this is not a major improvement. The second thing that they've done is that we are having currently a movement in favor of the banking union. But the banking union is not complete. We have a single supervisor, the ECB. Yes, thank you. Do we have a resolution fund, a single resolution fund, to match the possible crisis, bankruptcy of a bank or a group of banks in the euro area? No, we don't. There are funds that banks are putting in the funds, but progressively until 2021, what has been said is that the ESM might be used as a backstop in terms of helping a bank close to bankruptcy not to go bankrupt, but we will be assessing this new opportunity by 2020. So nothing happened. Okay. Finally, agreement last Tuesday. There should be possible instruments for competitiveness, convergence, and stabilization in the EMU to strengthen the resilience of the euro area, as the Germans and the French have proposed. But this is finishing by technical discussions. Continue. End of the story. So these are the latest changes in the governance of the euro area. In the morning, Bruno Le Maire said that this was a major change in euro governance. He was very happy. Of course, they were the yellow jackets, so he wanted to say, okay, in Brussels something good has happened, so stop talking about the yellow jackets. I have had something good to tell you. I've been very successful. There's no success here. Nothing has happened, okay? Unfortunately. So this is a long-standing problem. So let me now come to my recommendation. The backdrop is that we lack some convergence in the euro area. We may be trying to change the agenda. Some of the proposals I proposed are easily implementable without any treaty changes. Some are requiring some treaty changes. The point I was making earlier is that I don't care. Okay? This is not because we are told that the Germans will never accept that we should not be trying to tell this would be a better solution and discuss. Because maybe all the things I propose are wrong. You will tell me. I will be very happy leaving and saying, okay, I was a nut, I understood nothing, that's bullshit. Okay, but I will be able to discuss, maybe defend some of my arguments, and maybe you will convince me of the contrary. If we continue to always find out the compromise, we know what happens. Okay? Nothing happens. In the euro area, nothing has moved for years. Okay? The only changes we have had is more stringency in the rules that we have had so far. Okay? Never more flexibility, always more stringency. So what do I propose? So I have 8 minutes. First thing is that real convergence is an issue. Countries must be left in the possibility of improving their own situation through their own policies. But if they are not able to achieve the steady state themselves, they might be helped by some common tools. And there is a tool that works, which is namely the cohesion policy. Okay, we have it. This cohesion policy is existing. It is a very small amount of money, but the literature on this considers that it has been relatively effective. Okay? So there's no paradise with the cohesion policy, but when you have some German economists dealing with this cohesion policy, Becker et al., they showed in their first paper that if you put €1 of transfer, part of the cohesion policy in a region, it creates 1.20 euros more of growth in this region. This is called a multiplier effect, okay? A Keynesian multiplier effect. These people tell us it works. Okay? Of course, 2 years after, they say, okay, sometimes it doesn't work. But overall, it works, but they were a bit annoyed with the first result. So they say, okay, in some regions, it doesn't work. Why not? But we may try to improve the setting, but overall, it works. Rodriguez, Posey, and Garcilaso show that the quality of governments improves the effectiveness of cohesion policies. So this is not the cohesion policy that is at stake. It's the quality of the governments that receive the money. This is not the same story. Okay? So you can have some conditions. And Passimeni and Rizzo show that there have been some redistributive effects of the cohesion funds. I will leave you these slides and discussion. I do not mean that it has worked perfectly, but it seems it has been effective. Hence the reason why I consider that it should be boosted rather than reduced. At the moment we're talking, the proposal by the Commission for the next multi-annual framework, financial framework, is to reduce the common agricultural policy by 5% and cohesion policy by 5%. Okay. Sorry? To reduce by 5%. Okay? So, and I also propose that it should be increasing, but only for euro area member states, those that have been diverging. Okay? So we have the cohesion funds. They have improved relatively the situation of the entire EU. What I propose is to discriminate the increase in the cohesion funds towards the euro area member states, keeping in mind that the euro is part of our bodies of laws. All countries in the European Union should be having the euro. If they're part of the EU, they should be having the euro, except Denmark. Okay? Denmark has an opt-out clause, the UK as well, but no one cares about the UK. So that means that all the countries should be having the euro. So maybe we should incentivize euro adoption. 5, yes. Second recommendation. During the crisis, we have the European Union has created new bodies, new institutions, like the national productivity boards, which objective is nationally to give reports, advice on the competitiveness of the national economy, on the good or wrong evolution in the cost of labor, and so on and so forth. Okay. But these national productivity boards are left without coordination. There's no place, no institution where these different national productivity boards might meet to confront their point of views on the evolution of unit labor costs in Greece and the evolution of unit labor costs in Germany. Maybe it goes too far somewhere, too slow somewhere else. Maybe going a less slow in Germany, less strongly in Greece might be the good option. But if you think in terms of Nash equilibrium and you think the other will not move, you may go in the wrong direction or too strongly in the bad direction. So we should be having cooperation. And what we did propose with some colleagues, some German colleagues did that. They were working for trade unions, European trade unions, and we did that. This is what I presented last January here, is coordination of these different member states of the euro area, not on the level of the minimum wage, but on the evolution of the minimum wage. Because if I propose some changes, they must be implementable. Okay? So considering that it would be nice to have more convergence in the cost of labor within the euro area means that you need to have a policy to deal with that. And there is one wage on which governments have the upper hand. It is the minimum wage, with trade unions, partners, but they can tell something. What we propose, what I propose here, but did propose with some others, is that countries with the highest trade surpluses should be having the highest increases in minimum wages. And the countries with a deficit, trade deficit, or the lowest trade surplus might be considering having a slower increase in their minimum wages, so that this movement would make their competitiveness converge one to another. Okay? And that would mean that we would be talking not only about debts, but also about minimum wages at the level of the European Union and the euro area. The third recommendation is to use the idea by Macron of having a euro area budget dedicated to public investment, not to smooth the business cycle rapidly, but for structural reasons. If we make some public investment, it's not for coping in order to cope with an adverse shock. It's in order to create something of value, a university, money for the hospital, whatever. There are many, many ideas of public investment that are possible. Maybe we need to have a boost of our long-term output that would be related to this euro area budget, but not for smoothing the business cycle. A controversial point has been raised by many, many others before me, but not maybe with the same argument. The euro area is one of the very rare areas in the world in which there is no lender of last resort for government, and no sovereignty on the currency. Okay. The Fed is the lender of last resort for the federal government, the Bank of England for the government of the UK, the Bank of Japan for the government of Japan, and so on and so forth. We do not have this. But we have had something new during the crisis, which is the pragmatism of the ECB that has decided to monetize debt. Not on the primary market, forbidden, but on secondary market, seemingly possible. Okay. So finally, we have de facto a lender of last resort. But the problem arises of who will succeed to Mario Draghi. If ever it's someone very tough, the de facto lender of last resort will disappear entirely. So what is very striking is that if we want to stop speculative attacks against public debts within the euro area, we need a de jure lender of last resort. But if we have that, maybe we can have better coordination between governments and the ECB. The ECB would have some responsibility in taking care of risks for public debts. So maybe it will be more at ease to tell this fiscal policy is going too high. Why not? This would not be refraining their independence. For they would be part of taking care of risk sharing of these European public debts. Of course, it's controversial because you need to change the treaty and you need to have risk sharing. I already told you that this is not very easy in the system. Some absurd idea by me has been to change the public debt to GDP ratio. Totally absurd. I am fully against the 60% to GDP ratio limit because, as many other economists, but I can tell I told it very rapidly, there is no such thing as an optimal public debt ratio that would be non-contingent to the rest of the economy. So there are situations in which high debt level are good news, some they are bad news. Okay? So 60% is a nonsense. But I wanted to talk to the Europeans, some of which might not be sharing the same ideas as mine. So I said, okay, what was the logic of the 60% debt limit? Making an average in 1990 of the public debt to GDP ratio of those countries that might be entering the euro area within 10 years. So in 1990, the average public debt to GDP ratio was 60%. Growth, nominal growth, was 5%. Hence, the public deficit that would stabilize public debt to GDP ratio at 60 with 5% of growth was 60 multiplied by 5, 3%. Okay? Hence the limit. I said, okay, maybe we can take back the absurd logic, but say, okay, the euro will be 20 years in a few days. And during these 20 years, we have had some cycles. Not just one, many cycles. We have gone up, we have gone down. We have gone up, we have gone down. If I make the average over this 20-year period of the euro as it stood, not before it existed, I can tell that the average level is 80. That's absurd. But if we retain the logic and we have an increase in the debt target, and we must still converge towards the target, we have some margins for maneuver. 80% will be helpful for a country like Italy. Okay? That would be meaning that today we would be maybe accepting their fiscal deficit. Okay? I did that before they were elected, okay? So I'm not part of the deal. I'm part of nothing. Yeah, you're the only one to listen to me politely, I would say. Okay, so I know I'm almost done, but I need to tell you a few more things. Will you be giving me 5 minutes? I'm sure. Have you ever heard about the macro imbalance procedure? The macro imbalance procedure. It came to Europe that maybe we had a problem with real convergence, and we were in 2010, just after the global financial crisis. It was too late, but they thought that maybe we should be having some indicators to make sure that we can see early whether Spain was a good pupil or a bad pupil before the global financial crisis. Hence, we created a scoreboard of these almost 20 indicators. In fact, there are 50 indicators that countries must fulfill every year to show that they have no macro imbalance. Okay? And among these indicators, you have a current account balance indicator, which is asymmetric. Okay, I don't have time to discuss that. Okay, at the time it was computed, Germany had a trade surplus, current account surplus of, guess how much? 6%. Yes. Unfortunately, it turned out to be 8. So it's been years that they've been told to limit it, but it's not easy to limit it. Because what are the tools that governments have to limit a trade surplus? They tell it's not. It's the business of the private sector. Okay, so they can tell this, we can do nothing because that's the business of the business sector. But we have also this threshold. There's a threshold on public debt, consolidated private debt, okay? Which means that finally in 2011 and since then, we all have understood that public debt might be an issue, but private debt might also be an issue. So we need to cope with that. But as I was telling about Germany, there is no instrument to make sure that private debt might go below 133% of GDP. Do not ask me why this number, I don't know. I'm not sure anyone knows. I don't know, but there are countries above, but you can tell them you are above, you should be going below, and they say, okay, thank you for the information that I gave you, because they gave the information to the Commission. And finally, there's no tool. There's no tool, but there's a large asymmetry between public debt and private debt. We considered private debt might be an issue, but we have no tools to reduce it, although we have tools to have governments reduce public deficit. I do not mean that it's always perfect and working perfectly, and certainly it's good news, but the Greeks know that it has been painful to try to limit their public deficit. We have had tools to make the Greeks finally abide by the rules. But if the private sector was at stake, there would not be any sacrifices that should be done by the Greeks. So I propose, I told you I'm a nut, okay? A tax on banks. Because banks, or a financial sector, is mainly a banking sector. So if private debt have been soaring above 133% of GDP, it's certainly because there has been too much credit to firms, households that have created this situation, okay, and go beyond this situation. So my point was, it's very absurd as well. I'm absurd. Say, okay, but banks, if they are taxed, if ever the global level of credit, the stock of credit in the economy is going too much, certainly they will be finding ways not to achieve this position. Hence, we may have some private sustainability. The point I want to raise is that if ever this tax on banks did exist, it would never be implemented, because banks would make it sure that this target would be achieved, okay? Because they don't want to pay taxes. Okay? But this is a guess. I told you grey work, okay? But not very fashionable to want to tax banks at the European Parliament. Finally, a few remaining points. I discuss about how to deal with the identification of shocks to deal with cyclical convergence. It might be a trend that has been broken. Unemployment is rising too much considering the past. My point of view here is that the governments must fulfill a scoreboard that is too large, 50 indicators. I prefer 10. 10 related to macroeconomics that would give a picture of the evolution over time of the economies and the shocks that are being hitting this economy. If a shock does hit an economy, it might be having access to new rules like the German, Franco-German rules or whatever. Okay, so I think we should be limiting the number of indicators to identify the shock. The point, the 8th point, is that in contrast with Macron, I think, Macron's proposal, of course, I think that if we need some automatic stabilizers, we need them to be domestic. Okay? A country is being hit by a shock in its territory. It's not a large asymmetric shock. We must be able to use unemployment benefits, lower taxes to match and dampen the shock. But the problem is that during the years we have had the Stability and Growth Pact, and in order to fulfill the 3% deficit limit, we have limited the scope of automatic stabilizers at the domestic level. So saying we should be having a common backstop for having automatic stabilizers without saying this would be a reaction to the fact that we have decided to scrap national automatic stabilizers is not honest. Okay? So there is another option, is to improve automatic stabilizers in improving the progressivity of the tax and benefit system, the sensitivity of our tax basis to economic fluctuations. There are many niche, I don't know the name in English, exemptions of tax that make tax basis non-sensitive to economic fluctuations. We should be having this. We should be having sensitivity of unemployment to economic fluctuations, and unemployment benefits would help get out of unemployment, and we should be having shorter lags in the effective payment of taxes. I used this information from the Commission. When you attack someone, you sometimes have to defend yourself. Okay, so the best defense is attack. Yes, but sometimes I prefer to defend myself. Where do I find the information that national automatic stabilizers in the euro area are not effective? In a document by the European Union and the Commission, the report on public finances in EMU 2017, that shows that overall, the income stabilization of our automatic stabilizers per country is always below 43%. Okay? In the country with the highest automatic stabilizers, most effective stabilizers, Austria, the improvement, the smoothing is only 40%, 43%. If it were perfect, it would be 100. Okay, 100 it may be a difficult target, but 43% is very far from the objective. So we have an issue. Yeah. Yes. Maybe I will just tell you what. Okay, so you don't care about supply shocks. I just propose that obligation of means is scrapped, obligation of result is better. And why do we need reform? Because he will be leaving in a minute or two. Okay, thank you. Sorry for being long.
So now what we are going to do, the brief structure of our presentation would be, I will create a pathway for, I will go briefly what Mr. Creel has talked about, and then Mohib will go inside some theoretical framework, and Jannik is going to talk about the policy recommendation and also pose some questions. Just a quick history of ECC path to monetary union. So in 1957 we had this European Economic Community to establish system union and common market, and then there arrived in 1985 Schengen rules. So there was free migration. 1992 Maastricht Treaty, and eventually leading to Eurozone, and 1999 it's the beginning of Eurozone with 11 countries being the primary members, and then later Greece, Slovenia, etc. joined. Okay, sorry. So this is EMU is not a board. So we've already, I think Mr. Creel already discussed it. Sorry for using the mainstream artist in heterodox seminar, but anyways. So basically, so what is the cost and benefit of monetary integration? Briefly, citizens benefit from great price transparency, reducing costs for business. It's easier to make investment decision for the whole economy. It's so there's more price stability, lack of exchange rate risk. So, however, countries that adopt the euro can no longer exchange the interest rate of their exchange rate in a monetary union, so you cannot have an independent monetary policy. So basically there is a two view on monetary integration. It's a still ongoing debate that which convergence criteria should be actually used in for monetary integration. Quickly going to the recap, nominal convergence. It talks about inflation and long-term interest rate. So for example, countries with, so when countries with a similar interest rate, when countries have similar interest rates, they are supposed to say that they converge. And with real convergence, it's the theoretical framework is based on Soloson model, and so the idea is that countries having lower GDP, real GDP per capita tends to move towards countries with faster, towards the countries with higher real GDP per capita. So if we look at the economic criteria for joining the euro area, the price stability, so inflation cannot be higher than 1.5 points compared with the 3 best performing economic states, sound and sustainable public finances. I mean, we have talked about this. Government deficit not higher than 3% of GDP, debt not higher than 60% of GDP, exchange rate stability, and long-term interest rate cannot be higher than 2 points from the highest performing, well-performing economies. But what we can see from here is that it's mainly based on nominal convergence criteria. I think that's what the debate is about. So so the problem here could be like it does not give space to real convergence criteria, financial convergence criteria, and thus not giving a space for proper policy tools. And this we took from Mr. Creel's paper. So the real convergence should be taken into account, and it has subsets like steady state convergence that we already discussed, cyclical convergence and financial convergence. So more on real convergence, I would like to call Mohib.
Thank you, Anjesh, and thank you, Professor Creel, for your presentation. What I will be doing is basically talking about real convergence, what we understand by real convergence, and what I see as a possible obstacle to real convergence. So, for me, it was unclear what is meant by real convergence. Throughout your paper, you were referring to a steady state, and you were talking about balanced growth with price stability and full employment. And given that you were talking about the beta convergence, which is absolute convergence in terms of GDP per capita starting from a lower income, I think this is primarily based on a Solovian steady state growth model. And the mechanism on which it relies is that there is continuous substitution between the factors, capital and labor, to achieve this steady state. How this manifests in the Eurozone is that we have a free trade area, which leads to a equalization of the factor prices and harmonization of the legal framework and a free mobility of capital and labor. Now, I think given how pragmatic your presentation was, what I would be saying would be absolutely absurd using your own terms, because I would be making some theoretical criticisms about the solo steady state growth model, especially because there is a problem of sustaining this growth model outside a one commodity world. And all your definitions of real convergence depend on this particular identity, this particular relationship of the solo growth model. So I will be talking about structural and institutional divergence in EMU. Now, it is obvious that in the Eurozone, what you have is diverse economies with different institutional structures. And these are mostly regarding labor market institutions. And what has happened in recent years is that a lot of scholarship has focused on labor market institutions and how there's a different system of wage bargaining in the core and the periphery, and how this has led to diverging unit labor costs. Now, however, for the points that I will be making, what matters for international competitiveness is not cost competitiveness, but rather technological competitiveness, and I will come to this point later. So basically, unit labor costs do not matter so much in explaining the current account imbalances, and I will try to explain that point in the next few slides. What we also witness is a huge structural divergence between the core and the periphery. And by this, I mean a divergence in the productive structures. you have a productive structure in the core, which is characterized by high technology production. And on the other hand, you have a production structure in the south, which mostly relies on construction industry as a part of its value added. This is just one table where you can see that the difference between the manufacturing and the construction rate of returns on capital have been reduced in Germany, while they have been increasing in Spain. What this means is that there is a lot of capital flow from the core to the periphery, primarily in the construction sector. And this was facilitated by the credit boom that we saw in Spain particularly. Now, here is a table which I think should emphasize the structural divergence that we find in the European and Monetary Union. What you have is, from this, what we can clearly see is that the peripheral countries, especially France, Greece, Italy, and Portugal, have failed to keep up with Germany in terms of its industrial upgradation, in terms of its technological upgradation. So the value added component of high and medium technology is extremely low in the peripheral countries, whereas in the core, in Germany, you have had basically, they've upgraded, and their production structure, the value added is mostly in high and medium technology. So what this points to is that there is an absolute divergence in the manufacturing production structure in the core and the periphery. Now, because of this divergence in the production structure, what you have is a divergence in the export structure. So basically, Germany or the core countries are able to export commodities or goods which have a relatively high technology component to them. And which means that they're not competing on cost, but rather they're competing on technology. On the other hand, what you have in the south is that countries like Italy, Portugal, and Spain have to increasingly rely on low technology exports. And this has major implications of how the macroeconomic imbalances that you were talking about manifest. So the basic point that I'm making is that what has happened in EMU is that these conditions, criteria of nominal convergence, have led to a process of further structural divergence. And by this I mean that there is a diverging production structure leading to a diverging export structure. So this has certain important consequences. I mean, the first consequence is that if there is an increase in global demand, the periphery will benefit less and the core will benefit more, purely because of its production structure. And the other important fact to consider is because the peripheral countries are competing on low technology goods, they're usually crowded out by, let's say, Chinese exports in a common market. And therefore, what you see is a growing trade imbalance because of the nominal criteria that are imposed. So essentially, what you have because of nominal convergence criteria is that the euro, with respect to the rest of the world, is undervalued for the core and is overvalued for the periphery. And this is the reason why you have a growing trade imbalances apart from the intra-Eurozone imbalances. So, of course, what this means is that these are not just short-term trade imbalances, current account imbalances, but this points towards a more structural divergence within EMU with a common monetary framework. And for me, this points out to the need for industrial policies in the periphery, and especially given the policy proposals that you were making about a cohesion policy and also a public investment fund, I think that is what I would talk. I think Jannik is going to talk about the policy proposals.
Yeah, correct. I will go on with the policy proposals. And here are summarized all the 10 that you mentioned. I won't go through them. The writing is also getting a little bit small in this slide, so we just will focus on 2. And yeah, by the way, I'm German, but you don't have to be afraid. We are not on the same view as the Germans you met maybe in the European constitutions. Actually, we thought that all the policy recommendations are very profound and very important. So I would just focus on the coordination of minimum wage policy, because we think that this is one of the specific policies which is addressing a social dimension and also rather the bottom of the income distribution in Europe. And also the European budget, because it's very recent, but you also talked some parts about it, so maybe it will be quicker. So let's have a look on this graph. Mohib just raised the point of structural divergence and the importance of that. We discussed this a little bit, and we don't think that this point, which I will make now, is contradicting. So the 2 solid lines that you see are Germany and France, and basically it's their GDP per hour worked, and it's basically their productivity shown, and then you can see the dashed lines. So the green dashed line is France, which is paying a compensation per hour worked, pretty close to their productivity level. However, Germany is not doing that at all. So we have a huge divergence of German wages regarding the German productivity. And actually, a lot of the crisis countries, which you of course cannot see here, pay a wage above their productivity level. And now we come to this beautiful graph. Well, this is showing the imbalances in the European system. I want to make clear that the divergence in the wages that you saw just now is clearly not the only aspect of these imbalances, but it is one factor. And you can see that Germany, as you know, has by far the hugest surplus, and France actually has a deficit. Also, I think it's pretty good to see in this graph that the divergence in the current-account balance is really growing over time and is quite huge today. So there should be some changes. So this was the problem. What to do about it? We want to raise 2 points. We're actually not only aiming for a wage or for a coordination in the productivity boards of the countries, but also for a general wage convergence and the strengthening of trade unions in Europe, as their role is actually getting weaker over the last years. So the golden rule is something, maybe you know about it, it's already implemented in the European institutions, and the golden rule is saying that wage increase should be equal to the labor productivity increase plus an inflation target. Now, this is not actually what is standing there. So Collignon made a point, and he's saying if nominal wages increase at the rate of labor productivity growth plus the ECB inflation target of 2%, the wage shares stay constant in the long run, and the ECB can realize its primary objective of maintaining price stability. And on top, he's adding that the golden rule should account for an increase in the average efficiency of capital as well. So the next point you're also addressing is European minimum wage setting, and specifically there are suggestions that the minimum wage should at least be 50% of the country's average wage or 60% of the country's medium wage. So to have a little orientation to that, and yeah, clearly the minimum wage is increasing and stabilize aggregate demand, and also sets a living standard across Europe. So I think this is also important. Regarding the Euro area budget, so you mentioned 2 points which are the the potential for a budget to address or to counteracting the business cycle, and also to foster public spending in Europe. I think which could also be mentioned is like where does this need of a European budget really comes from, and it makes the importance clear in my point. So we have a centralized monetary governance, but the fiscal policies are highly decentralized and are they are of the nations. They're part of the nation. So but on top of that, the fiscal governance of every country is then determined by, for example, the Stability and Growth Pact, and they are not even free in their fiscal decisions. So that's also an important point. So as you already also said, the industrial policy in the south, public sector, it could, like this budget could target the promotion also of investment policies and to specific areas and industries to foster structural convergence. Now we're coming to the end of our presentation, and we want to start the debate and raise these questions towards you. Regarding the wage coordination, we want to ask you if European wage coordination is politically feasible, because the wage setting systems in each nation is quite different, and there has to be a homogenization also of that. So what do you think about the political feasibility? How could the financial setup of the European budget look like? Who's paying in that, how much? And we see a problem in the legitimization of the decisions, or not a problem, but how could decisions legitimize politically because of certain industry in certain areas could benefit more than others? So right now there are already voices, for example, in Germany saying that, oh, Germany is financing other countries' debt, and this could go in the same direction. It's just a political question. So then, in general, what is to be done to revive demand in Europe? And what policies could be implemented to counteract the differences in the industrial structures, maybe specifically? And also, how can the ECB provide inflationary convergence, as the ECB is rather orientating its interest policy towards the more higher income countries or deflationary countries, which is then for the disadvantage of the southern countries. What do you think about that?
Thank you.
So that's it.
Madit. So I take back the floor.
Yes,
for
the floor is yours.
Okay, thank you. Many thanks for reading the paper thoroughly and having so many remarks. So I must say I'm happy to raise remarks from you. I will be very disappointing in discussing all the things that you've been discussing, because I want to mention maybe the second point on theory, saying, okay, I've been very far from explaining very well what I meant by real convergence and what was the model that would be behind. The reason is that my thought was that I should be taking something for granted, that we should be aiming at the best situation, very abstract thing. the best situation might be higher GDP, it might be higher well-being, it might be related to the accumulation of physical capital, labor, human capital, whatever I want or people want. How do we achieve that? Okay, so the idea was maybe we need to think about how the European Union countries have been behaving over the years. So maybe we should be able to compute some trends in their evolution, which would be more empirical than it would be theoretical. And then using the apparatus of econometrics, being able to see whether a shock that we would put inside the model would move upward or downward. Maybe saying, okay, I didn't talk about industrial policies. I do not mean it's not important, because it's important, but I didn't know how to introduce it within the scope that was given to me. Okay, so, but you make a point, but if we use the empirical apparatus and say, okay, what would be impact on, let's call it potential output, that is a non-observable variable, of having this policy or this policy, what would be the best, what would be the impact of cooperation between different governments doing the same at the same moment? We could be dealing with the pace at which individual countries might be moving forward. And then we would be able, with the same empirical model, to know whether they have been non-expected shocks and how to deal with them with monetary policy, fiscal policy, income policies, and the like, without forgetting the issue of financial convergence. I've been working for many years on European issues, on fiscal sustainability, for instance. The point I was making when I was maybe your age, or almost your age, with Henri Sterdignac, was that there's no such thing as fiscal sustainability. We don't know what it means, fiscal sustainability. Maybe the US are getting bankrupt nowadays with large debt to GDP ratio they have. Maybe they don't. They don't, because whatever Trump will be doing might be reversed, even by himself, because he changes his mind very often, or someone after him, which makes debt in the US totally sustainable. So the debt in Greece was sustainable, up to the point someone said it is not. But as this person said, I was joking, it would have remained sustainable. Okay, so I wanted to have all this stuff, but I must admit that seeing your presentation, I would be happy to receive it, and we exchange. I will send to all of you my presentation, certainly to David, but after I would be willing to have yours. Okay, I'm disappointing on the issue of industrial policy. I didn't talk about this. I'm disappointing about the core versus the periphery, but to me it's implicit. Okay, if we have this issue of convergence within the euro area, it's between a core of the euro area versus the periphery of the euro area. And there are many reasons behind. But the point is, how do we improve the thing? And if one of the things I propose is to change, to some extent, fiscal policies, leaving some margins for maneuver to the governments, more common tools to maneuver, that means they can do whatever is needed, but I don't tell what is needed. Okay, this is just a step. So I take all your remarks very well, because that means that you were interested. Thank you very much. And these are the weaknesses of my work, and I acknowledge it, and I thank you for raising it. Now the questions, maybe. The last one is the easiest. How can the ECB provide convergence in inflation? It can't. Okay, it can't. It must fix a single interest rate for 19 member states. It will be able to achieve inflation convergence if and only if these 19 countries, behave the same. So if we are all the same, okay, it's easy to meet and to target the average, okay, because everybody will be at the average. So it's not the issue. So, but that also means that if it can't, there will always be many, many countries dissatisfied with the monetary policy by the ECB. Okay, at the moment, you were showing some structural data about Germany. When we have seen the gap between the compensation in Germany and the compensation in France, which has widened, not because France has accelerated the pace at which compensation were moving, but because the Germans have decelerated the compensations. Okay. At this moment, Germany would have been helped by lower interest rates to boost demand, because before the global financial crisis in the 2000 to 2005, the weak man of Europe was Germany. Okay? Everybody is forgetting it, but we should not. They were weak. They were weak because they had strong structural reforms that meant what to the people? Their wages were declining, consumption was negative, investment was very low. This economy was not investing in the future. This economy was investing in the future trade, international trade. But there was the global financial crisis. So just 2 years before the global financial crisis, Germany was reviving thanks to its mercantilism, thanks to mercantilism. So it was able to increase international trade, but then came the drop in international trade after the global financial crisis, and Germany was hit more by the global financial crisis than France, for instance. Okay? So at the moment they were having these structural reforms, they would have loved to have a drop in interest rates, whereas Spain, which was booming, would have loved to have higher interest rates. But the interest rates were on average. So dissatisfaction from the Spanish, dissatisfaction from the Germans. We cannot get inflation convergent thanks to a single monetary policy, which means that we need something else. We need labor policies, we need industrial policies, we need income policies, we need fiscal policies, tax policies, whatever. But we are fettered in these abilities by the Stability and Growth Pact and the reforms, as far as fiscal and tax policies are concerned. And there is no such thing as a cooperation on industrial policy or minimum wage policy. Okay, so we need something to converge one to another, but the ECB cannot provide it. It can only do one thing, but that would be a major change in its policy. It's in making convergence in the interest rates in the long run between the different member states of the euro area. It could help improve the convergence between interest rates in Italy and interest rates in Germany. Nowadays, there is the discrepancy because there are fears of a default risk in Italy, okay? And the ECB is saying, I cannot do anything about this. Although the ECB is buying public bonds for 4 years now, 3 or 4 years, large amounts of bonds. But it does so respecting the capital key of the ECB, meaning that the ECB has been buying public bonds, 20% or 25% from Germany, 15% from Italy, 20% from France, 2% from Portugal, because Portugal is 2% of the capital of the ECB, Germany is 25, etc., etc. No risk sharing. But that's written nowhere. So if they decided that the 60 billion euros per month that they were buying, 80 billion euros per month that they were buying in the past, had been concentrated in just one country, there would have been a large drop in interest rate in this country. Hence, the ECB would have been able to discriminate between the different member states, helping those in greatest despair. But it decided not to do so, although nothing forbids to do so in the treaty, as far as I'm aware of that. At the ECB, they said the contrary, but they cannot tell where it is written. This is the point. Okay, so this is one element of convergence. Is wage coordination politically feasible? It depends on where you stand. So today, the answer is no, it's not feasible. But 10 years before, or 20 years before, had it been possible to have the European Stability Mechanism, which introduces some kind of risk sharing between the member states? The answer would have been no. Would been able to have a Juncker plan boosting public investment and private investment in the euro area 10 years ago? The answer was no. No one was willing to hear about that. So yes, today wage coordination will certainly not work in the short term. But since the idea is being told by many, circulating, some might be arguing it might be helpful. And recall that it is not a rule on the amount to be paid as a minimum wage, but the evolution of the minimum wage year after year that we propose at OFCE. We've been working on this with the IMK in Düsseldorf and in Berlin, and the AK was part of it in Vienna, and the ECLM in Copenhagen in Denmark. Okay, so okay, not feasible. Would it be sector specific? At this stage, I told you I'm the naive guy. I talk about this with pragmatism that you mentioned, and but I've not written the paper that would prove it works or it doesn't work. I mentioned, I will come to your question, sorry, Pasimeni in my paper. He has made a very good paper on the coordination, possible coordination of wages and productivity within the euro area. So this guy has worked on it, I mentioned it, and I think it goes in the good direction. Sorry, you had a question.
No, it's not my question, but it's a question of the general public if they want to pose a question, because we are running really, really late.
Sorry.
So it'd be nice if
It's not your fault.
it's not your fault.
No, but okay. So please take question, and I think back about the questions. But
Emails, maybe?
yeah.
Okay. First one who wants to ask a question? Who was first? I think ladies first. Yeah.
Can we take three questions and I note down the you second, you Joseph, Chris, and okay, we can do four. And
thank you very much for the presentation and your
Thank
ideas. I'm Luisa. I'm from Austria, and that's why I'm speaking from an Austrian background now, considering the minimum wage proposals you mentioned. I appreciate that, so that like evolution of minimum wages should be considered. However, from my Austrian perspective, I'm not so much in favor of minimum wages because we have a institutional setting which is based on collective bargaining agreements, and a policy only focusing on minimum wages would probably erode the bargaining power of labor market institutions, so the labor unions and the Austrian Chamber of Labor. So can you see a way of respecting such national differences in the institutional setting and still follow a progressive program on that in that respect? And a short second question, if I may, considering the calculations of the budget deficit, you mentioned excluding the spending on automatic stabilizers. Why should we not also exclude spending on productive investments? Since, for example, in infrastructure, I think this is crucial to allow because it's improving the future product capacity of a country.
Yeah, we are collecting three
Yes,
questions.
I understood. I understood. I can.
also, it would be really nice if we make our questions a bit small, because we are really running late.
That's not our problem. 10 more minutes.
Hello. I'm Chris. I'm from Option C, which is development policies, and from Germany. But I can maybe agree to Jannik what he said there before. Anyway, I would like to ask you about the necessity of a lender of last resort and what is the current plans on the ESM and like the current development there, because I had the feeling that there is absolutely the need of a lender of last resort, and I think we all agree on this. But how far do does the Commission see the ESM in playing, like, how much does the Commission think that the ESM can actually play the role of a lender of last resort? Because I have the feeling that this institution should play this role, but not infringe, and I think it's Article 125, which the ECB thought, and which also German economists thought, that would necessitate the ECB to not buy more bonds of Greece, for example, in this case. So I think the Commission thinks that the ESM would then effectively play the role of a lender of last resort, but do you think this can be fulfilled by the ESM as institution? Because I kind of have my doubts in this.
Okay.
Hello, I'm Niels. I'm from Option C, also development and macroeconomics, and I'm French. My question is more towards political economy, maybe, since you might know better how general like guidelines are drafted in Europe, how they're decided and drafted, because we know about like the very strong influence of like lobbies in the short-term decisional institutions of Europe, like the European Parliament or the European Commission, but like in the global ideas, I'm wondering if the discussions are still extremely technical, and that a voice like this, which is really about models and empirics, is as powerful as it can get, or it's weakened by the same mechanics as in the other institutions.
Thank you. It's okay. Yes. Okay. Okay. So, excellent question about the collective bargaining in Austria. Of course, willing to discuss about the minimum wage will raise issues everywhere. There are sectoral discussions in Italy as regards the minimum wage, which means that if ever the proposal were implemented, that would mean that in Italy they would first have to have an institution to have coordination within Italy about these sectoral differences on minimum wages. So I do not mean it would be easy, but what I want the EU to take charge of is social policies. And one way of dealing with social policies, without only dealing with indicators of the amount of the young that are unemployed, the amount of women that are being out of work, the level of the wages of the women, which are good indicators, but on which we know there are no tools to modify things very rapidly. There is just one that exists, and it exists not for long in Germany. It's the minimum wage. So of course that will be certainly very difficult to match the desires of the very different governments that would be involved. Still keeping in mind that changing the minimum wage may or may not have an impact on other wages. Okay, indexation on minimum wages has changed substantially from countries to countries. The scala mobile that was existing, for instance, in Italy has disappeared for many years. So, of course, that would not be a panacea. But that would also mean that we will be talking about social issues. Europe will be talking of social issues to the people, rather than talking about fiscal austerity, 60%, etc. But I do not misestimate the difficulties that there would be. This certainly has been dealt with also by Austrian economists, so I must check. This is generally an idea that they had at the ETUI, which is the Confederation of Trade Unions at the European level. So certainly they dealt with this issue. I should be checking. About fiscal rules, I was thinking, I have been proposing, it was in 2002, a golden rule of public finance in the European Union. Okay. It seems my co-author and I were the first to propose it in Europe. It is an old idea, removing of fiscal rules, whatever the fiscal rules, any expenditures related to public investment. We did that with Jean-Paul Fitoussi in 2002. Then Blanchard did the same with Javazzi 2003, so we were first. And it seems that the internet is remembering this because we had a paper in the Economist, one page that was dealing with what we were proposing with Jean-Paul. We were told at that moment that we were naive. Why? Because everybody will put expenditures in the field of public investment, saying, okay, removing these expenditures from the target, we just have a minor amount of the expenditures, so that's it. We stick to the fiscal rule. So we were told by the Commission, by some other economists, it's totally nonsense to think like this because there will be some creative accounting by the Italian, by the French, to remove everything from the fiscal target. So we didn't do that. No one did that. And no one thought at that moment that maybe that could be a good idea, but we need a high-level group of very smart people, of whom I wouldn't have been, to discuss about what is a productive public expenditure. Because these walls here are certainly productive, but your professor is productive as well, but is not part of public investment. So while helping less developed countries, we have been able to find funds to build schools without having teachers in the school. A nightmare, okay? So we made mistakes. So what we need to figure out is what is a productive public expenditure. That should have been starting many years ago to think about this because this is still an issue. We don't know what is a productive expenditure, be it private or public, but a public one would have been better. So I was a promoter, but I lost ground. Harim, maybe you know Harim Truger? Oh, Harim Truger, yeah, he made many papers 2 to 3 years ago trying to promote once again the golden rule of public finance. As a good friend of mine, he was referring to our work, so he's the kind guy I know for years, and he's very nice guy. I hope he will be part of the group of the 5. Yes, it's confirmed?
No.
It's kind of confirmed,
yeah.
Yeah, okay.
No, it will be confirmed in
Yes, but it's going to be accepted.
usually, but it's not appointed by the ministry.
No, but I think it was.
So I hope Harim will have this opportunity to be practicing. Large challenge, but he holds it. He deserves it, sorry, in French, in English. The difference between the lender of last resort and the ESM is, to me, it's easy. The ESM has a finite amount of money. Okay? This finite amount of money is unable to match the next financial crisis and banking crisis. We don't have the money to match the possible risk of bankruptcy of a large country like Italy, for instance. If we were having a lender of last resort, we would be sure of one thing: we can create money. Some argue this will be creating inflation, but we are looking for inflation nowadays. So it would mean that this is not an issue in the short run. This could be in the long run, but that would require more cooperation between monetary policy and fiscal policy. It's not because you are independent that you cannot cooperate. Okay? When you go to the cinema all together, you are independent people sharing a cinema. Okay? This doesn't make you less independent to see the same movie as a friend. So the finite amount is a nightmare for the ESM. The lender of last resort, de jure, will be helpful. And how do we change the rules and the regulations? I must admit, having been part of the MIP once in my life, I was given the first piece by the Commission of the macro imbalance procedure. A political group asked me to give an advice. What I did see at that moment was that the MIP would consist of one indicator. A country would be having a macro imbalance if and only if it had a deficit in its current account. That was the first proposal by the Commission. So economists like me said, okay, this cannot work. So you must fight this. You must have symmetry. You must have other indicators. We gave a list. I don't remember the list I gave, and they made cherry picking. I didn't remove anything. But I know that they can ask for so-called experts. Maybe I was not the good expert in this field, but I knew that this was not the single imbalance to be limited. Say, okay, you must symmetrize. But then you have the idea of saying, okay, it's plus or minus 6, plus or minus 4, and it ends with plus 6 minus 4. Hence, the lobbying has worked. So it's a long process. We know that if ever we start with a proposal in which we compromise, in the end, it will be nothing. Nothing will happen if you're not ambitious. Okay, so it seems as if I think I am the ambitious guy. No, but if you try to compromise before you propose a change, you are sure that the change will be zero. Hence the compromise between the French and the Germans, the German and French economists, means that in the end there will be almost nothing, because they have already compromised. Okay? They have reached a consensual position on financial convergence. In the end, the government will look at it and say, okay, but this point is very bad for me, so we scrap it. This one is good for me, I keep it. Do you keep it? This cherry picking. So it's a long process, but you need to have a clear view about what you want. Okay. It's easy when you are outside. Okay. This is the role I had. It was a chance. I could have done it on my own and, okay, for my weekend. But I could write it down, say, okay, and it moved nothing. Maybe I was thinking about one thing that might have been used by what I did in the discussions, which could be that since I'm French and I am criticizing the French president's proposal on a euro area budget, it might have been used to say even the French are not agreeing on that, so scrap it, without considering is it a good or a bad argument. They don't care. So, okay. So many of these things are happening, and this is a long process. There is law in this that must be respected. So it's very difficult. But when you look at, you discuss with other disciplines, you also understand that talking about the same issue, we have different language, different concepts, and it's very difficult to reach an agreement. So imagine for European Parliament, the Commission, and the government. So disappointing answer, but it's a long process, but we need to be tough, convinced of what we say. Yes, sorry.
So it's the second round. And somebody.
All right. So no problem. So thank you very much for presentation. I'm Louis from option B, which is macroeconomics and finance, and I'm French too. I would have two questions. First, you mentioned the fact that Germany was quite the statement of Europe in the 2000s in a long process of adapting to future international trade structure and whatever. But a lot of narratives concerning, for instance, Italy would have similar arguments. People like Simonazzi, for instance, would say that Italy had a degree of investment in that direction. So my question would be, why has Italy been so frail? What was it so frail during the crisis? What hasn't been recovered yet, what Germany has? And my second point would be about your proposal of a counter-cyclical tax on banks. Although I like the idea, so it's a problem of implementation. Why not go for more, let's say, light touch measures, like those proposed by Paul de Grauwe, for instance, for different reserve requirements between countries, or Tom Pali's asset-based reserve requirements that could have maybe avoided huge bubbles in the south in this respect. Thank you very much.
You're welcome.
Hi, yeah, my name is Sophie. I'm from Option B as well. I actually have a brief comment to make because when you were discussing your proposals, and although the EU is very deficient up to today, I kind of had the impression that there have been a couple of proposals made, in particular the last 5 years. And I was wondering whether you have analyzed those, analyzed with your policy requirements. For example, I'm speaking of the European sovereign bond-backed securities proposal that has been released in the beginning of this year, which is definitely not a European lender of last resort, but is seen by European politicians as important, signaling towards the market that there is something moving in the European structure. So I was just wondering whether you have had a look at this and have put it somewhat in the context of the analysis that you've been running.
Hey, I'm Tore, also from Germany and studying development policies. My question is going into concerning the minimum wage policy and the structure of the advisory board. I didn't quite understand in your talk if you want to change the floor that we have on minimum wages so far and want them to transnationally coordinate the development on the basis of what the minimum wages are so far, or if you want to implement like a base for every country in a new way and then coordinate the development from there on. And I think no. Well,
thank you.
I don't think that the reforms in Germany in the early 2000s were the reason for the structural benefits that the German economy had. I think that already developed in the 80s, and the Agenda 2010 was basically what Macron is trying to do now in France, and didn't improve the competitiveness of the German economy, just caused that Germany couldn't import products from other, like the German demand on in the European economy was lacking, and this is, I think, also like the biggest reason why the declining or stagnating real USC is a problem for convergence in the EMU.
Okay. Thank you. So Italy's weaknesses are certainly not the same as Germany. The economy is more a peripheral economy in the sense that its comparative advantage is closer to that of least developed country or less developed countries, emerging economy than that of Germany. So the reason behind the difficulties that the Italian economy has had is the structure of the value added, the low value added of its exports as regards the value added of Germany. So they've been hit by a decline in international trade, but Italy has faced sharper competition from the emerging economies where Germany was not facing the same competition. Okay, so these are different stories that have put the Italian economy into despair. And if you remember certainly don't remember what happened 10 years ago because you were not caring that much about it. But the Italian, they thought via their prime minister, they had nothing to do with the global financial crisis because their prime minister at the time said, we won't be hit, we are very strong. And for a while, there were no good statistics saying, okay, there has been a drop in the GDP, but the drop has been large and as large as Germany. Okay, so these authorities in this country have totally underestimated the crisis that was occurring, which has made this country weaker than Germany that was able to fight as fast as possible the crisis. And the second difference between Germany and Italy is the level of the public finances. When the global financial crisis erupted, Germany was at budget balance, which meant that this country had margins for maneuver of 3 percentage points of its GDP, the largest of the euro area, to try to dampen the shock, which they did. Italy was already close to the 3%, hence its margin for maneuver was very small. Before, the Commission and the partners would say, you must decline your public deficit, which is the same story as France. Okay, so, and France is between the core and the periphery, depending on the issue. So two weaknesses that are different for Italy than for Germany. I take your remarks, Paul de Grove and Tom Paley. Yeah, you're right. I should have been mentioning them. So Paul is usually largely quoted in my paper. I didn't quote other papers. The fact is that I thought that it was important to have an operational target on private debt. And then I added this line, there should be a tax. But there are other things that should be done. So maybe I should have not write it down, but that would have meant there are no instruments. So this is a possible instrument, but I think I remain very prudent on this instrument, among some others. I'm sorry, and I must admit I didn't catch the sovereign-backed proposals. By whom?
It's actually by the European Systemic Report at the European Commission now, and it's supposed to make up for the missing bond market in Europe. Should I take a...
No, maybe it's late and...
Sure.
Yeah.
And if, no, actually, yeah, the sovereign bond-backed securities proposal was a proposal advanced first by the European Systemic Risk Board, basing on the SB's proposal by Brunnermeier. I think it was Brunnermeier.
Yes. These guys. Have you ever? Have you ever read Brunnermeier?
Yeah,
in English and not in German for the Germans because it's easier. I don't understand what he's talking about. So,
okay.
So it's so technical.
Yeah, it's very it's basically the proposal to set up a security basing on, because you've been talking about the capital key earlier.
Yeah.
And so it's the idea of taking this capital key and creating a bond pool of European government bonds and creating a security out of this, which is, so it's supposed to be a safe and liquid asset to buffer against other financial risks, so to break the sovereign bond nexus you've been talking about. And there's a lot of criticism in the room about that proposal because there's no mutualization, nothing. And so I was just wondering if you had looked at it.
This is a point, in fact, that has been proposed by the Franco-German initiative, in which Brunnermeier is one of the 7 German economists. And they want to build something that does not exist out of nowhere, to have a new safe asset within the euro area. The point I raise in my paper is that this safe asset does exist. Its name is the euro. The euro does exist with low inflation, be it between 1.5 and 3.5 of inflation per year. This is a very liquid asset. Okay, no interest rate. Okay, no interest rate on it. But at the moment, we have so low interest rate that no one is telling that these assets with a very low interest rate are not financial assets. So why not money? So I prefer money that does exist to something that does not exist. This is my reply to this. Very simple, but I think it's existing. So we should manage to capitalize on our currency. If we believe in this currency, if it's credible, it's a safe asset and it's liquid. So I knew about this proposal. If you say Brunnermeier, okay, I understand where it comes from. But very complicated, very complicated. And answering your remark, I do not mean that one should touch the floor of the minimum wage, but deal with the yearly change in the minimum wage. So that would change the floor, but year after year. If Germany has decided upon a minimum wage, it's not forever, because inflation will be growing thanks to growth in Germany, and good news for Germany, and that means it should be moving. The idea is that it should be moving faster than inflation if the trade surplus of Germany is very large in contrast with other countries. Why? Because it creates a spillover, this large trade current account in Germany and elsewhere, on the entire euro area, because that pushes the nominal exchange rate of the euro up at the expense of everybody. Okay? We are seeing a potential appreciation of the euro, which will mean lower price competitiveness of the euro area. This is certainly not bad news for Germany. For Germany, it depends on global value chains. For Germany, as certainly not only price competitiveness, but mainly non-price competitiveness. But for those like Italy that depend on price competitiveness, a higher euro would be a difficulty, an additional difficulty. Okay, so this is the reason why I'm pushing for this change coordinated change in the nominal wage, but not in the level. Okay. It's very late, and I'm deeply sorry for... Yes, I think you are in weekend. Thank you. Thank you.